good morning for those on the Central and West Coast. My name is Jim Scanlon. I'm the head of relationship management for Lear Investment Management. I'm joined today, as always, by Jim Warner, our head of research and co-portfolio manager at the firm. I'd like to thank you all for being on the call today and for entrusting us with a portion of your client's irreplaceable wealth. That is a responsibility, an enormous responsibility that we take very seriously here at the firm. As a reminder, we strongly encourage your participation by asking questions at any time throughout the presentation. There's a button at the bottom of the screen. Questions can even be submitted anonymously, so we certainly encourage you to ask away. There's obviously a lot going on in the markets, at the Fed, and geopolitically as well, of course. Jim has been very busy helping our clients make sense of it all, and I'm pleased to welcome him to the webinar today to provide his thoughts. Jim?
Great, thanks, Jim. I'm going to share my screen as I traditionally do, and thank you to everyone who is joining us today. So today's presentation, I've called it a possible Santa rally, which honestly would be really nice. You know, I've spoken to a lot of frustrated clients, a lot of frustrated financial advisors. We're going to talk about why that's okay, and also why after the last 10% drawdown, you know, we got a lot of phone calls, and that's what we're here for. We're here to help. Obviously, the market's bounced pretty dramatically in the last few days. The S&P, after dropping off 10%, has now rallied 6%. That was a fantastic opportunity for us to add stocks, which we did last week. So we'll get into all of that. We're going to talk a lot about what's happening in terms of our views on things like inflation. But then I have a number of slides that you should stick around for on the actual trades that we've done and how we've kind of repositioned the portfolio in the last few weeks. So let's dig in. The culprit obviously has been interest rates. With the long end of the curve coming up, that has really driven all of the volatility in both the stock and bond market. You know, this is the graph of the 10-year Treasury bond yield, which touched 5% and couldn't quite get through it, and is now kind of pulled back into the 4.5%, 4.6% type range, which is great, and that is basically what has driven this rally. You know, as we've mentioned before, it's not just where these rates are, and that is an issue, but it's just how fast we got to close to 5%. It's the fastest level that we've, you know, you know, rate hike, if you will, we've seen in decades. And you know why that matters is it drives obviously asset valuation, i.e., through the discount rate, and it drives economic growth in terms of higher borrowing costs. And on that particular point, you know, we just don't know exactly how this is going to impact a lot of business models. And we're going to talk a little bit about that later. But that's something that's really front of mind for us as we think about going into next year. So, you know, when you wake up in the morning, you know, look at where the 10-year is doing, and you're going to have a good idea of where the stock and bond market's going to go. So if the 10-year is down, you're going to see the market up, both markets, and vice versa. So that's what's basically been going on. You know, if we take a look at how the yield curve shape has changed over the last few weeks, this, I mean, it's been a pretty dramatic pullback from, you know, from the highs of, you know, this is just basically a week ago. You can see how far it's dropped, particularly out the curve, and that's really been the big driver. So, you know, the first point I'll make is that the 10% pullback that we experienced as rates were rising is normal. It's actually normal. About every year, there's about a 63% chance that you'll get a 10% pullback. So it's not out of the ordinary. And so it's not something that honestly should really freak us out. We actually should look at it as an opportunity. And that's exactly how we approach it. But what then moved this nice, and so if you were adding as the market was pulling back, you were richly rewarded during the last week. This move downward in rates was really a combination of three things that happened last week. Number one, Treasury provided their issuance calendar, and it turned out they were going to issue a little less debt than feared. Secondly, we had no action by the Fed, and frankly, the general tenor of Jay Powell's conference call was, or you know, post meeting presser was basically, not as hawkish as what he had been previously. And really third was the lower payroll number we got on Friday morning. So that really created really a pretty furious short covering rally. And so, that actually could continue. There's a lot of evidence out there that a lot of the institutional investors are very short this market, very short interest rates, and we could see that pretty much that unwind, creating a Santa rally, which is fairly traditional anyway. But then, we're gonna, as we'll point out a little bit later, I think that we then need to watch out as we enter into 2024, as economic concerns start to, I think, become greater. So, I mentioned before how we got a lot of calls, a lot of nervous investors, a lot of frustrated investors and clients. And it's okay to feel that way, not just because of the 10% pullback we experienced, but because the last 2 years really has been an enormous struggle for investors. If we look back at what's happened over the last 2 years, it's really principally been generated by generationally high inflation and then surging interest rates to counter that. And that's basically driven a lot of volatility in the market. And part of that volatility has also created exaggerated shifts in what's working. I mean, if we look at this table here, for example, in 2022, we all know how bad that year was, right? The S&P was down 18% and bonds were down 13%, which is really, really rare, right? And so that was just, there was nowhere to hide. The Magnificent Seven, as Jim Cramer calls it, the Apple, Amazon, Google, Microsoft, Tesla, Nvidia, and Meta. Those 7 stocks are really basically about the only thing that has worked in this market today. And so because they account for nearly 30% of the S&P 500, they have driven the S&P 500 in, whether it was last year or this year. Last year, they were down 40% as a basket. This year, they're up 60+%. With the rest of the S&P essentially flattish. So the one thing that we've counseled people, investors to look at is don't just look at the headline 15% S&P 500, because generally speaking, most investment firms that are they're actively managed and are seeking to generate alpha aren't going to just be, index chasers. They're not going to see that 15%. What their returns are going to look more like is something akin to the equal weighted S&P 500, which are barely up for the year. And then when you look at the aggregate bond, that's actually provided no refuge either. It's down, it's basically flattish for the year at this point. So it's fine to be frustrated, and it's fine to be frustrated over the last, few months, and it's fine to be frustrated over the last 2 years. It has been a frustrating market. So the thing I spent a lot of time on, and we've mentioned this in previous calls, is housing prices and our theory and our thesis that they're going to roll over pretty hard. Why does that matter? It matters because it drives the inflation headline numbers, core PCE or CPE, the important things that the Fed looks at in order to determine whether they're going to raise interest rates or not. And but what's interesting is that the current narrative we think is complete fantasy. The current narrative, which is basically propagated by the National Association of Realtors, is that the real estate market's dead. There are no sellers because they have low fixed rate mortgages, and there's no forced sellers because credit underwriting didn't get out of hand and was quite solid during the run up to today. There's no adjustable rate mortgage cliff like we had back in 07, 08. And we have very high loan to values. So everything's fine. There won't be any forced sellers. And there's still a lot of demand due to household formation. So the conclusion in the current narrative is that there's a limited supply of homes, and that limited supply should help prices remain at or near all-time record levels. Now, we think that's completely false. And the principal reason is that there is no demand for homes right now. There is a complete buyer strike. Why? Because homes are at record unaffordability. Prices are up nearly 50% around the country, home prices, that is. Mortgage rates are over 8%. Even if they pull back 100 basis points, the reality is that buyers have been priced out of this market, which means something has to give, right? So we looked at, for example, if you look at what's going on with mortgage applications, for example, they are approaching near zero. This is a Mortgage Banker Association index on mortgage applications, which, you know, are a key sign of buyer intent. If you're going to go through the hassle of getting a mortgage approved, you're probably going to be, be buying a house. These are down 90% since the 2020 peak. The current index, which I don't think the index has ever been this low, is also, I think, accelerating to the downside. October versus September, we're down 16% as mortgage rates crossed 7%. That was most likely the reason. So there's a buyer strike. And then the reality is that there are forced sellers in the market. Why? Well, we can see it. Listings are starting to grow. There's a number of different places that we check, data points where we check weekly, all around the country. And why is that? Well, one big reason is home builders. Home builders, and I'll get to them in a second, but they have to continue to sell homes. That's their business. Number two is Airbnbers. So a lot of folks, and you can check there's a great website called AirDNA that evaluates the various Airbnb markets. And you can clearly see that supply of homes for rent have just skyrocketed over the course of the last couple of years. Lots of homes were bought in 21 and 22. And you've now seen a huge fall off in bookings. And you can see all this clear as day on AirDNA. The other thing that's happened here is that home insurance and property tax cases have, in some cases, doubled or even tripled in various markets. It's pricing people out of their homes that they're currently in with great mortgages. And you're seeing this in Miami. You're seeing this in a little bit in Arizona. You're seeing this in Austin, Texas. So this is a huge issue. And then, of course, you're going to get your typical normal amounts of volume from death, divorce, and new job elsewhere, the kind of typical things. So there will be listings. There are listings. And we think that the deeper these price cuts go, the more forced sellers will come to the fore. So in short, there will be price discovery. There isn't a world that can possibly exist where absolutely zero people sell their homes. And so long as there are, and homes remain as unaffordable as they are, prices are the thing. Price is the thing that has to break. And by the way, we can see this in new home prices. So you can see on the chart on the left is that home builders have a record level of homes under construction today, way more than we saw even in the prior housing, before the last housing crisis. And they're going to have to offload them. They are already dramatically cutting prices, and they are also buying down mortgage rates. D.R. Horton had their earnings call yesterday, and they mentioned that they are averaging around 6.25% for conventional mortgages. That's still pretty high compared to where most people are sitting with 3%, 3.5% mortgages. So you can see that they're having to offer these discounts to move inventory, which is their business model. And you can see on the chart on the right that new home prices in October were down 16% year over year. Okay, now keep that number 16% in your mind, because that matters for what I'm going to tell you in a couple slides. But we think that there is a flood of new homes set to hit the market, and it's at the exact worst possible time. So we'll see prices collapse in that area. And the reality is we're already starting to see it happen. And will it spread to existing homes? Eventually it will. But if we just take a look at this slide, I went on to Lennar, one of the major home builders websites, and I actually counted up out of the 293 listings in their 48 developments that are in the Houston area, principally to the north of Houston. 75% of the homes being offered have already cut their original list price. And here's just a sample on the right. You can see some of these cuts are really dramatic, like 20%. I've even saw yesterday a 30% cut. And some of them are, still around 7%. But again, these are negative numbers, and 75% of their inventory is effectively on sale. Which basically means that if you harken back to your good old days of Econ 101, yes, there's less supply, but we're getting a demand shock, right? This buyer strike is creating no demand at current price levels. So they have to go lower, look no further than what the home builders are doing. So why does this matter? This matters because this factors into the core PCE number, which we've talked about in the past. And I just, basically copied and pasted this chart from last month's presentation. But the core PCE right now is 3.9%. And people say, oh, the inflation is sticky and it's not coming down. And, does the Fed need to hike in December? No, because a big chunk of that core PCE is driven by the government's view that housing prices have went up 7.4%. Well, clearly they're not going up 7.4%. I can show you a bunch of other statistics as well. So what happens, and the point here is that if we get down to even just housing prices down 5%, then our core PCE is down below the Fed's target. So the Fed's not going to hike. In fact, what concerns me more is what happens if housing prices need to go down 15%. I mean, remember, they're already up 50% since 2019, when we basically had fairly low mortgage rates relative to where they are today. And so if that happens, now, the clarion sounds for deflation. And that's the one thing that the Fed and any economist does not want to see, is deflation. And so this leads to our increasing conviction that next year we're going to see some pretty dramatic rate cuts by the Fed. And that has a lot of implications that we'll get to here in a second. So let me talk about what we've done recently in the portfolio. As I said, pullbacks like the one we got are normal and should be taken advantage of. And so we've done that a few different ways. And I'm just going to touch on about 4 of them. Number one is we have gotten pretty bold up on Japan. We think that Japan is rising again, finally, after decades and decades of complete disappointment. In fact, most investors have completely shunned Japan for the last 3 decades. We think it's time to actually revisit. And so we've been increasing our exposure there. It is why? Because it's one of the best places to take risk. Where do you want to take risk? You want to take risk in economies and countries that are at an economic equilibrium. Well, what do I mean by that? Well, if you look at what's going on in our country or in Europe, we overstimulated the economy to countercorrect for the COVID lockdowns and get the economy back on track, but we overdid it. And now we're dealing with the inflation from that, and we haven't yet totally normalized, right? Inflation isn't back to 2% yet. We haven't gotten back to kind of what I think is probably normal, more steady interest rates. There's all sorts of disequilibrium that is still in the market and in the economy today. And Japan is that is much less the case, principally because they didn't stimulate, they were locked down for quite a bit longer, but they never really stimulated in the same way that the US or the European nations did. And so there's less of an inflation issue to deal with. Now they do have some. It's a mild 3%. It's trending lower, and that's also helping interest rates rise. Remember, this is a country that has dealt with deflation for the last 3 decades and almost like negative interest rates in some cases. And so just having interest rates near 1% on their JGBs is actually a pretty good thing. And so when you take a look at that and an equity market valuation that's really pretty cheap relative to the rest of the world, then throw in some technical factors of Japanese people are way underweight stocks. Japanese corporates are being fairly aggressive in buying back their stock. This starts to look pretty interesting. On top of all of that, the Japanese yen has lost 33% of its value to the US dollar over the course of the last 3 years. And we think that that's set to somewhat reverse, maybe all the way, but with the end of the US tightening cycle, there is a massive, very popular carry trade that a lot of institutions have put on where they short the JGBs and they buy the US Treasury and they capture the spread. Well, if US Treasury yields start to come down as they are, and JGB yields start to come up, we think that is actually going to put a squeeze upward on the yen, and that's going to make our this particular trade look very attractive. Excuse me, in the coming months and quarters. So The other thing that we like about this is that it diversifies us away from the US. Now, remember, our core strategy, global vigilance, goes anywhere. We can do anything. And so if we have issues with the US market, we don't have to be there as much. We're always going to be there, of course, but we can always diversify away. And so we've done that through this trade. Now, the other interesting position we put on, and by the way, we manage a whole bunch of different strategies. And so what I'm telling you does tend to filter across all of them, not just in global vigilance, but that is our flagship. So I tend to always talk about that first. But the other interesting trade that's gone on is to watch the overreaction to Ozempic and all of these weight loss drugs that the market apparently feels will be so pervasively used and so effective at reducing obesity that it will change all sorts of different consumer behaviors. And more importantly, it will have a material impact on the volume of surgeries, such as knee replacements and other types of surgeries, or reduce the need for glucose monitoring. And the market's become so concerned over this that it knocked down, in this case, all of the shares of these medical device companies. What we bought actually was an ETF that reflects these medical devices. It sold off 20%, and you can see it in this graph here. And we just think that it's completely irrational. The best way to capture this and express it to you is that if you look at what the Abbott CEO just said on his earnings call, they expect 10 to 15 million people to take weight loss drugs, which is nothing in comparison to the roughly billion people that have diabetes and cardiovascular disease. So, this is one of these scenarios where when you get big pullbacks in the market, fears about something, whatever it is, in this case, it's, weight loss drugs and whatnot, tends to exaggerate downward moves in stocks. And so one of the most important things you can do in a pullback is take advantage of this. Take advantage of this irrational thinking. And that's exactly what we did. The other thing that we have recently put into the portfolio is more exposure to defense. And specifically in the global vigilance portfolio, we put in Lockheed Martin. We've been looking at the defense industry very closely ever since Russia invaded Ukraine, for obvious reasons. The thing that we hadn't actually been completely comfortable with was really understanding the dynamics of the US budget. We obviously have a huge deficit to deal with, which may constrain the military budget in the future. But what has really happened over the course of the last year and a half, and now I think really sort of the Israeli-Hamas conflict really kind of puts a finer point on it, has been the reaction by both NATO countries as well as countries like Japan and Taiwan and Korea to basically dramatically increase their defense spending. The world is getting more dangerous. There's no question about it. Regional conflicts are growing. And this means that geopolitics is a growing structural risk for any portfolio. And so we think it's really critical that we had some representation of the defense industry in our portfolio. And the reason we basically chose Lockheed is that they tend to be the one name that has the most exposure or could have the most exposure to foreign military sales, which is a very important part of their business. And for example, they manufacture the HIMARS missile system that has become fairly popularized in Ukraine. And they also have the F-35 fighter jet, which is now getting tons of orders by foreign countries, and many other weapon systems that are now in significant need, not just in Europe and the Middle East, but also in Asia, as countries like Taiwan and Korea worry about the threat that China poses. So all in all, this actually is, I think, an excellent hedge for the portfolio. And then the final trade or position that I'll talk about today is mortgage REITs. And I've talked about mortgage REITs ad nauseum for the last, basically 9 months, 6 to 9 months. And we were really kind of ramping up our exposure, but we think we're finally getting traction. See, mortgage REITs work great when the yield they earn, so from the mortgage-backed securities they own, and that yield now is north of 7%. But when the yield they earn exceeds the cost of their hedges and the leverage that they use to kind of to buy more. And this happens when mortgage-backed security spreads and overall, fixed income market is not collapsing. Now, the last 3 or 4 months has been a horrific period for spreads and the overall fixed income market. And so these names that we have in the book did not work. But with some measure of calm returning, these REITs can actually earn a very attractive yield. In fact, the economic returns that they have range in sort of the range of 15 to 20% economic returns, which supports dividend yields in the same neighborhood. That's phenomenal, right? That's phenomenal for any position to be generating that kind of dividend yield, and we think those are actually secure. Now, that's the base case. We earn that kind of return on these, plus a little, because we think these stocks could return to more trading at book value or even a little north of book value where they're currently trading at a discount. So we love this trade right now. The best case scenario is some serious equity-like returns if tangible book value grows. And there's really one way that happens. That's if mortgage-backed security spreads tighten. Mortgage-backed securities spreads today are at close to the same level they were at the height of the housing crisis. So, this massive blowout in spreads creates a really unique opportunity. I mean, we're talking about a 3 or 4 standard deviation event. If there is any sort of normalization to where mortgage-backed security spreads normally trade, the book values could increase tremendously. The example that I give here is that a 50 basis point spread shock, like we just experienced, it will actually grow tangible book value between 15 to 25%, depending on which company we're talking about, which would translate basically to a 15 to 20% increase in stock price. And you've seen just a giant bounce over the course of the last week. We think that there's probably more to come over the coming year. The other thing I would mention, by the way, and this is for those advisors that actually, they're invested in our product. If you simply look at the like the Schwab statement that you have, and you go and you look at, we're on the website, and you look at the unrealized gains or losses, that's not the whole picture on the return of these individual securities. You have to add in the income that is getting kicked off into cash. And so it's really important when you think about how do I look at the performance of these stocks. It's not just the stock price. You have to add in the income to get the total return. I can talk more about that later if that's of further interest. All right, so stepping back, where do we sit here in terms of the portfolio? Going into the month as the market was headed down, we trimmed some exposure to the mortgage REITs and other things that we thought in the portfolio were at risk of higher, interest rates. And, when the market's in a frenzy, you don't ever know how high the interest rates could surge. And therefore, it is a prudent part of our risk management process to trim those things. Now, as the market bottomed and reached that 10% pullback level, that's when we started to add the various different names that I just mentioned. The one that I didn't mention on this list is, there's a couple I didn't mention, but we added a oil and gas name. We think it's an excellent company, tremendously cheap stock, returns a ton of capital, no balance sheet problems, but it's really important to have in the portfolio as a hedge if the Israeli-Hamas conflict expands and creates a spike in oil prices. The second thing that we added here that I didn't speak of before is a consumer staple that the consumer staples, for whatever reason, got completely hammered in this pullback as well. And this is an opportunity to buy just a world-class name that Kenvue, that is a spinoff of the consumer healthcare business of Johnson & Johnson. So this is, think Sudafed, Tylenol, those types of brands are in their portfolio of products. So very high quality business. And that's really important. It's really important as we start to think about next year and a decelerating economy. We need to make sure that we're buying names that have defensible earning streams. That's going to be very important going forward. So all in all, we increased the equity allocation of the book. It's still very conservative. And then I think the other thing that I would make a point of is that we think that there's a legitimate bond rally that has started. And that's going to be really important for the portfolio going forward. So let me talk about that in a second. As most of you know, we have a tactical approach, and this is just our visual way of expressing that. Think about this as being kind of a slide, an asset allocation. That's one way we adjust risk. And we are sort of right here, just slightly above a 50-50 kind of allocation. We're about a little bit more than 50% equities. And depending on how the economy evolves, we'll change this. I think what's most likely is we're going to probably be adding some more bonds next year. I think that's going to be probably the opportunity. But we're seeing a tremendous amount of value in stocks too, particularly after the last pullback. So, but this is one of the levers that we use to kind of manage risk in the portfolio. All right, so let me just finish up with these two last slides, and then we can take some questions to start thinking about what those might be. Short term, like next few months, I think we can get a Santa rally in stocks and bonds. Earnings have been pretty decent. We're almost entirely through the earnings season, and if you look at the S&P 500 members, the average earnings beat has been about 8%. So a good, decent set of quarterly announcements. And honestly, I feel a little bit like a broken record because every single quarter for the last maybe 6 to 8 quarters has been, we've entered every period worried about recession, worried about whatever. And yet we kind of escape the earnings period or move through it, and it's not as bad as we feared. And that's sort of what's going on here as well. Why? Because the economy is still in pretty good shape. And I think the other obvious thing is that interest rates have now started to head a little lower, and we think that they could potentially continue to head lower next year. Thinking about how we view the impact, particularly of housing prices and other prices in the economy that are now in deflation or disinflation. We think that inflation is sort of a thing of the past, but we also wonder, given that we're still elevated at even 4.5% 10-year yields, and certainly the front end of the curve is still maxed out at 5.25% to 5.5%. What does this mean for businesses and their earnings going forward? And so, what we're spending a lot of time thinking about is, if I'm a CFO right now and I'm preparing my 2024 budget, I probably am budgeting an interest expense that is double, maybe triple what I paid last year. So if I'm a levered business, I really need to think about how I'm going to offset that increase in expense. And one of the ways that you traditionally offset that is by laying off people. And so I think it's very probable that we will see over the course of the next month or two a number of layoff announcements. And that will create a softer job market, which again is what the Fed wants. But that's something that we think is going to be, happening over the course of the next couple of months. And I guess in short, we're pretty confident that we're in names that aren't going to have to do that. But that is part of the, kind of the mosaic of thoughts in our head, as we think about where numbers need to go for next year. We really don't want to be in businesses where they're revising down numbers, is the long and short of it. So we also have a lot of stocks today that are, technically oversold. There's other things like tax loss harvesting season is basically over for the institutions. Companies that were in their quiet period are for earnings are now out of it and buying back their stock. And we think that in general, basically investors are going to need to chase returns into the year end. So I think a Santa rally is possible. We don't think that this is though a situation where you just slam your foot, against the accelerator and take a bunch of risk. Because there are still some things out there that could reach up and grab the market, such as, a nasty government shutdown. Honestly, I think that would be more of a blessing than a curse, but there are things out there that could happen, externalities and whatnot, that are hard to forecast, that make us not want to take too much risk. But again, we feel very confident that buying this past dip was the right thing to do in light of the short-term outlook. Now, let me offer you, and this is our last slide, a preliminary view of 2024. We think that there's a much higher likelihood of recession. We've been in this camp, of where we think there's been these rolling recessions occurring. We saw it first in in goods, trucking. We saw it in tech last year. We saw it in banks earlier this year, energy at the end of last year. So it's been this sort of rolling set of recessions, but it never really impacted services, largely because labor markets remain strong, so spending has remained strong. Well, we think that um, the as I've just mentioned, the impact from higher interest rates on the labor market could drive up unemployment. We think that consumer spending is likely then going to decelerate. And then, of course, we have our thesis on what housing prices are going to do, which will drag the inflation numbers down. So all of this sort of makes us feel like we're due for cuts next year and a slowing economy. And so what that really means is that that's a great market, finally, after really 3 years of losses. It's a great market for bonds. And the reason why it makes us, we actually feel confident that it's an environment where you can actually earn a return, is because we finally have the bond market to lean on. And we have really great yields to lean on in the bond market. We haven't had that opportunity over the course of the last 2 years, those frustrating 2 years where there was really no place to hide. We now have a place to hide, which is gives us which is heartening. The last thing I'll talk about before we turn over to questions is the election. This is a complete wild card. I don't even know who's going to be running next year. I mean, could it be Trump and Biden? Could it be somebody else? I mean, there's a million different ways I think this could work out. I think generally speaking, the market as a whole kind of looks through elections. There may be some volatility along the way. More importantly is what certain sectors do. So take, for example, if the White House goes Republican and even the Senate flips, you can be rest assured that our oil, our energy trade, and our Lockheed Martin trade will work terrific, right? And so there's all these sector-based issues that you need to process, but it's way too soon to be thinking about that. It's just something I wanted to make sure that I mentioned, but we'll tactically adjust as we always do as we, process polling information. So I think next year's going to be a great environment for bonds and maybe tough for the stock market. So we're going to have to pick and choose our stocks very carefully. So let me stop there, Jim, and let's take some questions.
Great, Jim. Thank you as always. Got a few questions here in the queue, and just a reminder, if you have a question, by all means, click the Q&A button at the bottom of your screen. We'd be delighted to answer it for you. First question, Jim, why do you think a government shutdown would be more of a blessing than a curse?
Well, I went through this a few months ago when government shutdown looked like it was going to happen. And basically, a lot of the analysis is that it has very little impact on GDP. It's a very, very small drag. I think more importantly is that we have a serious budget deficit problem. We have the worst budget deficit in the history of this country at a time when we're not in recession. So we have absolutely no flexibility to stimulate the economy fiscally should we roll into a recession next year. I think if we can put the grown-ups in the room and ultimately get some sort of deal on spending, that is the ideal outcome, and it's certainly something that needs to be done.
Okay, a couple more questions. Can you reconcile the prediction of lower rates with the lower U.S. Treasury needing to maintain higher rates to sell notes and bonds?
Right. Well, I mean, think about it this way. If you're the Treasury and you're out there selling 5% yielding bonds or 4.7 or whatever it is, wherever you are on the curve, why would you not want that versus a 1% JGB or a 3% Bund? Or, if you look across the G20, we have basically the highest interest rate. I mean, exclude like Russia from that, but we have basically one of the highest interest rates. And so that's creating insatiable demand for that yield. So, if rates were to go down significantly lower, number one, that would make debt service less of an issue. And so this whole issue would become less of a problem. But more importantly, it would make obviously owning the US Treasury less attractive relative to other options. But the fact of the matter is, if you're a large, institutional investor, the US Treasury is often offering whoppers of yields that no other country is offering.
Okay, great. Couple more questions here. What is your assessment of the the potential economic or market impact of the Israeli-Hamas conflict?
Yeah, so I mean, obviously, the you know the terrorist act that was committed by Hamas, and then the Israeli sort of retaliation is it's a horrible human tragedy. But from an economic standpoint, it actually makes very little difference to the world. It's makes a big difference, obviously, to Israeli companies. We don't have any exposure to those, but from the people that I've talked to over there, I mean, some businesses have lost half their employees as they've gone back to the military. Where there could be an impact and is if in some way the conflict broadens and somehow either Iranian oil production is slows, or something happens to the Suez Canal, which is right nearby Gaza. That would be bad, and that would create a spike in oil prices. That's one of the principal reasons why we added an oil company to our portfolio, is that we would have that hedge in place where kind of that not likely, but were that situation to happen, oil prices would spike, and that would be great for that business. So so all in all, it's just very little impact at this point.
Here's another question just came in. It reads, I've heard that inflation is going to be harder to reduce because there's an increased employee bargaining power with products coming back to the US. Wage growth for low earners has continued to increase. Do you see the same?
No, not really. So what's really happened, first of all, we do not have a lot of union where you're seeing a lot, where the headlines are on wage growth right now. And wage growth, by the way, overall is declining. The inflation embedded in wage growth, that is decelerating. But where you see the headlines, of course, is in the auto worker strikes, where they're getting these huge wages. That's a very, very small percentage of the working population. And, frankly, that's not really going to move the needle or the trend line. But where you actually bring up the lower earners, this is actually where you're going to see actually probably the biggest drop in wage inflation. The lowest earners had the largest wage gains during the pandemic. And so, you couldn't find people to work in restaurants or whatnot. And so you saw enormous gains there. You also saw enormous gains because of the fiscal stimulus, and how that was targeted towards lower earners. We're lapping all of that. And the sad reality is that they are the first to get fired. And so you're already starting to see kind of wages, decelerate and decline there. So at the end of the day, if you step back, you look at pre-pandemic and look over a whole range of years, typical wage growth is around 3%. We're currently around 4%. I think we're gonna basically converge back to 3% probably in the next 6 months.
Okay, and one final question here, Jim. You spoke of deflation several times. Is the portfolio currently positioned for a deflationary environment?
I'd say we have a lot. The way I'd answer this is that we have a lot of the pieces in place. They may not be sized appropriately. So take, for example, if we get really nervous about deflation, we'll probably increase the size of our bond positioning. We'll probably increase the size of our position in gold. But we're not there yet. And so, we just like the Fed are data dependent. And so we will react as things happen, but we have a lot of things in place that would do quite well in a deflationary environment. We're there, but we're not all the way there yet because we frankly don't have the data to support it.
Perfect. Great, Jim. Thank you. That wraps up all the questions that we have. So with that, we'll close for the day. Thank you again to everyone for joining us. We'll have the replay available shortly. We'll have that sent out. It'll be posted up on our YouTube page. As always, if there's anything we can do to help you in any way to answer any questions you may have after this webinar, please feel free to reach out to any of us on the team. We're here to help as always. So Jim, thank you, and thank everyone else, and have a great afternoon.
Thanks.